Welcome everyone to Vested Interest. This is Shane back again for the stock pick of the day video. It is August 7th. Today we're going to take a look at one out of the consumer staples sector. One of the first companies that I actually added to this dividend growth portfolio. We are going to take a look at Kraft Heinz Company. You probably have a lot of their products in your fridge or in your cupboard. Let's jump right in. So if you want to know more about the company, check them out, www.kraftheinzcompany.com. That's www.kraftheinzcompany.com. That is their homepage where I pulled this information from. And they are a food company, basically. They have a lot of brands, like I said, you're probably well aware of. I know a lot of them are in my cupboard, in my fridge. My kids eat them all the time. Beloved global brands. They are a global company. They have their footprint all over the world. A globally trusted producer of delicious foods, the Kraft Heinz Company provides high quality, great taste and nutrition for all eating occasions, whether at home, in restaurants, or on the go. You've got Kraft and Heinz, right? At one point they merged together. Oscar Myers, Ore-Ida, ABC, Capri Suns, Philadelphia, that's the cream cheese spread, plus some others that they have, Golden Circle, Honig, Masters, Kraft mac and cheese, Waddies, Lunchables. I mean, my kids eat Lunchables, Plasmon, some of their sauces at Classico, Kool-Aid. Who doesn't know Kool-Aid, right? Pudlisky, Quero, Velveeta cheese, Weight Watchers, Maxwell House, Smart Ones, Jello. Who doesn't know Jello? And drop down in the comments if you remember the old Grey Poupon commercials from the 90s and the 2000s, where a guy would pull up in a real fancy car to someone and say, "Pardon me, do you have any Grey Poupon?" Do you remember those commercials? I always thought those were pretty funny and got a kick out of them whenever I'd see them. I'm probably dating myself a little bit. Let's jump right in here and see why we are looking at them today. Well, they were down 0.79%. We are talking about the Kraft Heinz Company, ticker KHC, out of the consumer staples sector. Closed the day out at $35 even here, 52-week range as low as $32.73, as high as $42.80. Average volume 7.7 million. Today was 7 million. And it was a very big sell-off in the beginning of the day. Looks like they leveled out a little bit, but big drop first thing in the morning. Market cap of $42.953 billion, a beta of 0.67, so they are less volatile than the overall market. That's what beta means. 1 being the market, anything less than 1 being less volatile, anything over 1 being more volatile. Price to earnings, PE ratio here is $17.86 per share. Basically, that means you are paying $17.86 for every dollar of earnings they make. EPS, earnings per share, is $1.96. Earnings date, the next one coming up will be between October 24th and October 30th. Their forward dividend is $1.60 paid on the year. They are a quarterly payer, and we will see that here in a minute, what they pay out per quarter. Their dividend yield, very nice dividend yield on this one, 4.54%. Ex-dividend date is August 31st, so if you were to buy them now, you would be in line for their next dividend payout, and they'll make that payout on September 29th, it looks like. And a 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, of $41.54. And I am not affiliated with Yahoo Finance, just one of the sources I like to go to for information. Now, I like to jump into statistics and look at dividend yield theory. So the way we do that is we go into, you click on statistics. If you were to go to Yahoo Finance, click on statistics, go over here down to dividends and splits, look up their 5-year dividend average, 4.91, and we compare that to their current 4.54, or over here, forward annual dividend yield, 4.54. And since it is lower than their 5-year average, this speaks to some overvaluation on this one. If this number was higher, if their current was higher than their 5-year average, that would speak to some undervaluation. They are inversely correlated. They do have a low payout ratio of 62.50%. Well, not really low. I like 75% or lower, so they're at least under what I look for as far as my basis. You choose your own basis. Some people don't like to be over 60. Some people don't like to be over 50. I don't mind 75% or above, or 75% or lower. I mean, anything above 75, unless it's a REIT or possibly a utility company where they pay out a higher percentage. Typically, REITs have to pay out 90% or more. I'm not worried about those if they're over 75%. But for a company like Kraft that's been around for a long time, I don't mind if they're up there in the 60, 70%, right? If they were a younger company still growing that dividend and growing the company, where they want to reinvest a lot of money back into the company so it can grow, then I would be concerned. But for this one, it's been around a long time. Short of adding or making acquisitions, they're probably not going to be growing extremely fast. People who are buying Kraft Heinz products are going to continue to do so. Then we'll look at under financials, a lot of good information here. You can look up their revenue, you can look up their balance sheet, their income statement, their debt to equity ratios. You want to look at all that information, see how they're doing financially, and you can also look up their free cash flow, which is what I like to look at to make sure that they have growing free cash flow, because we want our dividends to grow over time, and dividends are paid out of free cash flow. Acquisitions are made out of free cash flow. They pay their debt out of free cash flow. They can buy back shares, pay your dividend, obviously. But let's look at it. 2019, they were at 2.7 billion. 2020 up to 4.3. 2021 up to 4.4, and then a big drop. So nice growth from 2019 to 2021, but a big drop here in 2022, right? 1.5. So that is a big drop. So it's something to watch to make sure we want to see growth from 2022 to 2023 again. But nice growth here for the first few years, but then, like I said, big drop here from 2021 to 2022. So that's something to keep an eye on. If it was to drop again in 2023, that would definitely be a trend you don't want to continue to see. They are repaying their debt. That's nice to see. Let's keep on going. I always recommend more than one source. So another one that I like is StockAnalysis.com. I'm not affiliated with them either, just another source I like to look at, and I always recommend more than one source so that you can back check the information that you are getting is accurate. So we will look at the 12 stock analysts here that have taken a look at this. They call it a consensus buy. They have a low estimate of $38, and it currently sits below their lowest estimate. So if it came back up to their $38 low estimate, that would be an 8.57% increase in the stock price. They have an average estimate of $41.92. That would be a 19.77% increase in the stock price. And if it happened to hit their high of $50, that would be a 42.86% increase. All the while, you could collect that 4+% dividend yield, 4.5% currently. Now, this site is going to give you the same information, just in a different format. It does go back a little further than Yahoo Finance does. So if you were looking at the financials, you could go back further than 2019. But same information, balance sheet, income statement, revenue, debt to equity, assets over liabilities, all that information is under financials. Statistics, it gives you some different information, the margins, a lot of information in there as well. One of the things I like to look at is return on equity and return on invested capital. And again, you'd go into statistics, and I like 10% or better on both. So this is a little bit of a mixed bag. The return on equity is a little lower than I like at 6.5%. The return on capital is above the 10% I look for at 17.10%. So again, a bit of a mixed bag on this one. Free cash flow declining from 2021 to 2022. Dividend yield theory says they're slightly overvalued. Return on equity not quite where I want it. Let's jump over and see what we can find on their dividends. So full disclosure on this one, I am a long-term investor in Kraft Heinz. Even though the numbers don't look exactly where I want them, I am adding to this one as it is below my cost basis. I do have 160.71 shares. My cost basis is $37.17 per share. It's currently under there at $34.99. So I am down 5.84%. Loss of $350.40. I mean, not really a loss because I'm not looking to sell them, but a unrealized loss there. If I was to sell them, then I would book that loss. But so long as I don't sell them, I'm not booking that loss. But they do have a low payout ratio, like I said, 62.5%, or at least under what I consider low 75% or less. But the thing they don't have is dividend growth, right? 40 cents, and I went back to 2022. It's been a while since they grew their dividend. So they have to have a high yield, 4% or better, for me to be interested in a company that does not grow their dividend yield. And I am hoping this is more of a kind of a turnaround play here. This is one that's in Warren Buffett's portfolio. This is one, to be honest with you, he says was a mistake. He overvalued this company. And even though my cost basis is lower than his, I may have overvalued it a little bit as well. With the drop in, I bought this a couple years back, free cash flow was still growing, and that's what I was hoping would continue with the recent drop in from 2021 to 2022. It's one that I'm going to be watching closely. One, to see if they restart their dividend growth. Two, to make sure that their cash flow their free cash flow begins to increase again. And 3, to continually add to this, a little bit here, a little bit there, so I can continue to bring down my cost basis, bring up my future return and my dividend yield. But right now, according to dividend yield theory, like I said earlier, this one is a bit overvalued. So I would not jump into this one right now if you do not own it. I would wait. I would probably wait to see if it sets a new 52-week low, maybe down into the 32 or below range, would probably put it about fair value. It's pretty close to fair value now, but I would want it, if I were you, a little bit below fair value because they do not have dividend growth, right? And I did not look at these companies. I will just flat out say this is one that I did not do a lot of research that I should have done beforehand. I just looked at it. It was a company that I knew. It was a company I was familiar with. I used their products, so I went ahead and buy it. Just because you use a product or understand the company or know the company does not mean you should go out and buy it. You do want to look at valuations. Not understanding the value of a company is a good way to overpay for a company. So there are a lot of sites out there you can look at for discounted free cash flow calculators, or sites that will estimate the value of a stock for you. If you compare 3 or 4 sites, you want to pay for a site that does that. There are a lot of them out there. I have a discounted cash flow calculator that I use whenever I'm looking at a company to see where it's at for fair value anyway, and then I set that price. That's kind of how I use the 15% of the 52-week low as well, to see if that's anywhere close. So I have my investing criteria here on the next page. You'll see that, but make sure you set up your own investing criteria and you make sure that you have that in place before you are investing in any individual stocks. And if you want to take all the guesswork out of it, maybe ETFs and index funds are a better way to go. That's up to you to decide. Now, this is my investing criteria. This is a stock screener I run stocks through to see if I am even interested in buying them, and then I will do a deeper dive if they meet this criteria. Understand the business, growing free cash flow for the last 5 years, growing dividend payout ratio of 75% or less. It does not apply to REITs or BDCs, right, because they have to pay out a higher distribution than other companies that are required to by law. Check valuation based on dividend yield theory. Buy below current cost basis or within 15% of 52-week low. Return on equity, return on invested capital, return on equity equal to or greater than industry average, or 10% or greater. I really like the 10% or greater, but sometimes the average is not 10% for their industry, so I'll take that in consideration. And I add this last one for financial companies: must be a price to book around 1 or lower. And then it must meet 4 of 7 if it's not a financial company to even be investable, and it must meet investable, and it must be 5 of 8 if it's a financial company. This is also how I set up the videos, right? This is why I look at the information in the videos the way that I do. So let me know what you think of Kraft Heinz. Like I said, if it's not in your portfolio, it's one I would be holding on a little bit. I think there is going to be, if the information technology and these other sectors continue to run up, it may be one that pulls back a bit. Usually does if we are in a new bull market. Usually, I will say, some companies tend to pull back, like utilities, energy sector, and consumer staples like this company here tend to pull back whenever the tech stocks run, and we're in a big bull market, because that's where everyone likes to dump their cash. They get out of the safe plays and they go into the more speculative plays to try to get that stock appreciation instead of collecting dividends. But I'm a dividend growth investor, so I use those as buying opportunities. Well, this video is getting a little long, so let's just wrap it up. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community, building a community of like-minded dividend growth investors so we can share our experiences, stocks we're watching, stocks like this. If you have some stocks that you'd like me to cover in the Stock Pick of the Day series, go ahead and drop them down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice of a consultant, a certified financial advisor.